Silver didn't rally into $115. It detonated into it. And when a metal that's supposed to be liquid, boring, and fully priced by the world's most sophisticated markets moves like this, the real story is almost never the number on the screen. The real story is what the number is trying to warn you about, because $115 silver isn't just a price level, it's a stress test. It puts the market asking a brutal question out loud. If everyone who holds a claim suddenly wants the actual metal, is there enough to go around, and who gets it first? Here's what makes this moment genuinely unprecedented. In January, a month that is typically quiet for COMEX silver deliveries, delivery notices didn't just tick higher, they surged into historical territory. On Tuesday alone, 355 standard silver delivery notices were issued. Month to date, January delivery notices climbed to roughly 9,000 contracts, translating into about 45 million ounces of physical silver demanded for delivery. And that's before you add the micro silver notices, which push the total delivery demand to approximately 46 million ounces in a non-primary delivery month. While silver is trading around $114. That combination is not normal. It's not even unusual. That's a structural anomaly so large it forces you to stop thinking in terms of daily charts and start thinking in terms of system integrity. To understand why this matters, you have to understand what January is supposed to look like. The COMEX has a rhythm. The primary delivery months, March, May, July, September, and December, are when you expect heavier delivery activity. Those are the months the machine is built to handle with predictability. January, by comparison, is usually where the exchange catches its breath. Inventory management, replenishment, preparation, a calm before the next wave. That's the theory. But markets don't care about theory when trust changes. And what we are seeing here is not just demand, it's demand behaving like a message. Because when a futures holder stands for delivery instead of rolling the contract forward or cash settling it, they're making a choice that cuts through all the noise. They're saying, I don't want the paper representation of silver, I want silver. That's it. And when that happens at this scale, when nearly $90, 200 contracts stand in a single month, you're not looking at normal market participation. You're looking at a shift in confidence. Each COMEX silver contract represents 5,000 ounces. Multiply that out and you'd be staring at a physical pull request of roughly 45.9 million ounces in a month. That was never supposed to host that kind of stress. Now here's the detail that should make you lean forward. This January isn't just high. It's reportedly more than 5 times the delivery demand seen in January 2025. 5 times in an off-peak month. That doesn't happen because of a headline. It happens when a large enough group of participants decides, quietly and independently, that a paper claim is no longer the safest way to hold exposure. And once that mentality takes hold, it spreads, because every ounce that leaves registered inventory makes the next holder more aware of what the system actually is. A confident structure that works beautifully until too many people ask it to do the one thing it exists to do. Before we go further, I want you to lock in one point, because it's the difference between signal and internet theater. This isn't speculation. This isn't a rumor. This isn't an anonymous source. COMEX delivery reports are hard data, real contracts, real notices, real metal that must be delivered or accounted for. And when the report itself is warning that if this pace continues through February, the exchange may be nearing critically low inventory levels by the time March begins, that's not a dramatic YouTube line. That's the system flashing an amber warning light. March is a primary delivery month. The baseline demand is already higher. If January is already pulling 46 million ounces, you don't need imagination to see the risk of collision when seasonal pressure meets a new class of demand that refuses to accept paper settlement. And if you're getting value from this breakdown, if you want more of these investigative mechanics first videos, take 1 second to like the video and subscribe, because what's happening in silver right now isn't a one-day story. It's an unfolding process, and the next chapters will move fast. Now let's talk mechanics, because the entire drama sits inside a simple assumption the futures complex has relied on for decades. The assumption is that most contracts never result in physical delivery. They get rolled forward, offset, closed, or cash settled. Delivery happens, but for a minority. That's not a conspiracy. It's how these markets are designed to function efficiently. The problem is what happens when the minority becomes a movement, when a rising percentage of holders says, no roll, no cash, deliver. The machinery can technically handle delivery, but it was never built to handle delivery at scale under stress, while price is rising, while confidence is fraying. And you can feel that fraying when you look at behavior. High delivery numbers aren't just logistics, they're psychology. They say, I would rather hold the asset than trust the promise. And that is a contagion dynamic. Because once someone sees physical being pulled aggressively, the rational thought becomes, if the line forms, you want to be in it early, not late. That's why these moments can accelerate. It isn't about everyone waking up on the same day. It's about a gradual repricing of counterparty risk, where each new data point nudges more participants toward the same conclusion. Now layer in the price action, because price is not leading this story, it's reacting to it. Silver cleared key resistance around $110 and pushed into the $114 zone, with $115 to $120 now sitting as the next technical battleground. Momentum has the kind of texture you see when demand is real: stronger up days, lighter pullbacks, and a market that refuses to give back gains easily. Technical analysis can describe that behavior, but technicals cannot tell you what matters most here: whether the underlying commodity is becoming scarce in the place that sets the reference price for the world. And when the physical market tightens while the chart turns bullish, you get the most dangerous type of move. Not dangerous because it's volatile, but dangerous because it can gap. It can reprice in steps. It can create moments where the screen looks liquid until suddenly it doesn't. If the physical demand continues at anything close to this pace into February, the market isn't just approaching a higher price. It's approaching a different regime. This is where history becomes useful, not as prophecy, but as a lens. The Hunt Brothers episode in 1979-1980 remains the most famous example of what happens when physical pressure overwhelms exchange inventories. Silver went from single digits to over $50 before the rules changed and the market snapped. The point is not to claim a replay. The point is to remember the mechanism. When a delivery-based pricing system is forced to confront the limits of deliverable supply, the adjustment can be swift and violent. And the most important difference this time is that the demand doesn't appear to be one concentrated player trying to corner a market. It appears broad-based, distributed across motivations that do not all respond to price the same way. Industrial users are the first pillar. Silver is not just a shiny metal, it is a strategic input. Solar panel production, EV manufacturing, electronics, grid infrastructure, data centers. All of these require silver for conductivity and reliability. And most people miss the critical detail. Silver supply does not scale easily with price because so much of it is produced as a byproduct of other mining. If copper and zinc economics don't expand, silver doesn't magically flood the market. That's why structural deficits matter. They don't create fireworks every day, but they turn the market into dry timber. When a spark hits, it runs. The second pillar is institutional behavior. Institutions do not move like retail. They move when risk models change. And one of the most under-discussed shifts of the last few years has been the repricing of counterparty risk across the financial system: banks, clearinghouses, settlement plumbing. When confidence in paper claims weakens even slightly, sophisticated holders begin to prefer assets that do not require someone else's promise to perform. Gold gets the headlines, but silver sits in an unusual position: monetary metal, industrial metal, and a market structure historically comfortable with leverage. That mix becomes unstable when enough people demand the underlying. The third pillar is geopolitical fragmentation, export controls, reshoring, strategic stockpiles, block formation. The world is increasingly treating supply chains like national security. And when commodities become strategic, demand stops being purely price sensitive. It becomes availability sensitive. That matters because it changes how shortages manifest. Instead of a clean bid on a chart, you get delays, premiums, sourcing competition, and a quiet migration away from paper venues toward direct physical procurement. And then there's the paper structure itself, the fractional nature of claims versus deliverable metal. Futures markets and the broader bullion ecosystem can run fractional because they assume most holders do not ask for delivery at once. That's not inherently fraudulent, it's functional leverage. But leverage is only stable while trust holds. The warning signs show up before a break: backwardation, basis distortions, regional premium gaps, and then, eventually, a surge in delivery demand that doesn't match the calendar. That is what January is screaming. A non-primary month behaving like a primary month on steroids, while price is already elevated. So when you ask what could be driving 46 million ounces demanded for delivery, the most honest answer is several forces are converging at once, and the market structure was never designed for convergence. That's how systemic events begin, not with one cause, but with alignment, where industrial need, institutional de-risking, and geopolitical urgency all pull in the same direction, and the release valve becomes price. Except that price only works as a release valve if metal can actually show up. Now let's drop into the mid-video reveal, because this is the connective tissue that makes the story coherent. The delivery surge is not just about silver being bullish. It looks like a global repricing of counterparty risk, an accelerating preference for allocated, deliverable, controllable metal over paper exposure. After the repo shocks, the bank stress, the emergency interventions, and the growing sense that the modern financial system is run on confidence and coordination, a rational actor asks one question: when the crowd panics, will my claim still behave like metal, or will it behave like a liability? And once you ask that question, you start converting paper into possession. That conversion dynamic has a compounding effect. Every ounce removed from registered inventory changes the math for the remaining claims. It forces the next holder to consider whether they want to test the system later, when inventories are lower and pressure is higher, or now, while the machine still looks orderly. That's why these moves can look calm until they don't. The system can absorb stress until the day it can't, and it rarely announces the exact day in advance. It announces it through data, like this. But balance matters, so let's acknowledge the mechanisms that can slow or contain an immediate crisis. The exchange can raise margin requirements, making it more expensive to hold long positions and discouraging speculative demand. Additional metal can, in theory, be sourced from other venues and moved into registered status, though that process is expensive, logistically complex, and often a sign of tightening rather than comfort. Some holders who initiate delivery notices may ultimately accept cash settlement or roll, meaning final delivery totals can be lower than the early month pace. And price itself can reduce marginal demand by forcing weaker hands to take profits and industrial buyers to optimize purchases. All of that is real, and yet none of it eliminates the core tension because the fundamentals behind the pressure remain. Industrial demand is not a fad, and the infrastructure build-out around energy transition, AI expansion, and defense modernization is silver-intensive by design. Geopolitical fragmentation is not reversing. And once trust in a delivery-based pricing system begins to weaken, it is extraordinarily hard to restore without a reset that reprices the underlying to a level that reduces stress. That is how markets rebalance leverage, not politely, but through repricing. So here's the question I want you to sit with, and I want you to answer it in the comments, because it reveals how you see risk. If March arrives with primary month demand on top of this new delivery aggression, and registered inventory is already strained, what do you think the system chooses first? Protecting price discovery or protecting the plumbing behind the market? In other words, does the market allow truth to print on the screen no matter the consequence? Or does it change the rules to preserve settlement? Because that's the deeper story inside $150 silver. It's not about a target. It's about governance under stress. It's about what a paper-dominant system does when too many participants ask it to act like a physical market. And once you understand that, you stop watching silver like it's just another ticker. You start watching it like a confidence barometer for the entire settlement structure that props up modern commodities pricing. So where does this leave us right now, late January 2026, staring at delivery demand that S 5 times normal in a non-primary month, while price hovers in the mid-teens of triple digits? It leaves us at a hinge point. The evidence is loud, but the event is not complete. The COMEX is strained, not shattered. The move is powerful, but not yet parabolic. And that in-between state is the most dangerous environment for people who wait for certainty, because certainty arrives after repricing. The headline comes after the opportunity. The confirmation comes after the stress has already forced the market to adjust. That doesn't mean you throw caution away. It means you track the right variables. Delivery notices, registered inventory trends, whether February demand cools or stays hot, the behavior of premiums and availability in physical channels, the relationship between major venues and any persistent regional premium gaps. These are the signals that show whether the market is simply in a strong bull phase or whether it is moving toward a structural confrontation between claims and metal. And let me be very clear in the language that matters most. This is not financial advice. This is mechanics. It's about understanding what the system is telling you. If you're holding physical, this data validates the thesis that delivery pressure is real and that paper versus physical tension is not a theory, it's measurable behavior. If you're a trader, the setup can be bullish while still being extended, and sharp pullbacks can happen as profits are taken. If you're new to the space, understand that in a tightening physical environment, the price you see and the price you pay can diverge, because premiums and availability become part of the market's truth. But regardless of where you sit, investor, trader, or simply observer, the most important instruction is the simplest one. Verify independently. Read the delivery reports. Don't outsource your conviction to a personality. Markets like this punish blind certainty and reward informed adaptability. If this January pace continues into February, the runway to March becomes very short, and primary month dynamics could collide with a system already burning inventory. If February cools sharply, then January may be remembered as a violent warning shot rather than the opening of a full-scale squeeze. Either way, the data has already done its job. It has revealed where pressure is accumulating. And here's the unresolved tension, the one the market itself is about to answer. Do delivery demands moderate and give the exchange breathing room, or do they accelerate and force a repricing that acknowledges physical scarcity and counterparty fear at the same time? That's the fork. That's the story. That's why $115 silver matters. Stay sharp, protect your capital, ignore anyone pitching you miracle trades, and watch the delivery data like a heartbeat monitor. Because in markets like this, the screen price is only the surface. The real story is underneath, where the metal is, who can get it, and what happens when too many people ask the same question at once.